In our previous chapters, we learned how to enter information into the accounting system. In this chapter, we're going to be examining the ending balances in our accounts and determining if any of those balances need to be adjusted. Over the period, changes occur that might require an adjustment in some of our accounts. For example, equipment will wear out, prepaid insurance and supplies get used up, and employees earn wages that have not yet been paid. So since these events haven't been entered into the system, we need to perform adjusting entries so that our financial statements will be exactly correct at the end of the period. The adjusting entries that we're going to be performing in this chapter are guided by three accounting principles. The first is the revenue recognition principle. It states that revenue should be recognized when they're earned, regardless of when the cash is received from the customer. For example, if we performed a service in the month of January, but we didn't bill the customer until February, we need to make sure that that revenue is recorded in January and not February, because in January was the month that the revenue was earned. The expense recognition principle is really similar. It states that expenses should be recognized when earned, regardless of when the cash is paid. For example, we incurred advertising expense for the month of January, but we did not receive the bill until February. The advertising expense does not need to be in February when we got the bill. It needs to be recorded in January when the advertising was performed. And then there's the matching principle. It requires the matching of revenues earned during an accounting period with the expenses incurred to produce the revenues. So you remember that expenses are paid out to help us earn the revenues. So the expenses that we paid to help earn the revenues in a specific period need to be recorded together. For example, if I have an expense for January, I need that expense to be offset against January's revenues, not February's, maybe when we receive the bill. So that's going to provide the best measure of our net income. So we are going to be following all three of these principles when we create our adjusting entries. And it's so important to get those adjusting entries done before we prepare our financial statements so that they will be correct. We can prepare the financial statements monthly, quarterly, or at the end of the fiscal year. The fiscal year is a 12-month period of time used as an accounting period. It doesn't have to be the calendar year. So it doesn't have to go from January to December. Our fiscal year here at the school runs from July 1st to June 30th. So it can be any 12-month period. The first adjusting entry that we'll look at is for supplies. This example says during June, Mitch purchased supplies for $80. And if you recall, when we record the purchase of supplies, we debit supplies and credit cash. So we have this $80 in the supplies account, which is an asset. According to an inventory of supplies at the end of June, there were only $20 of supplies left on hand. So if we started with $80 in supplies and we only have 20 left, that means that $60 in supplies was used up during the month of June. So we need to do two things with our adjusting entry. We need to bring the supplies account down to 20, which is what we really have left on hand, And then we need to record the $60 in supplies that we used up. And we'll do that with a journal entry. We're going to go to our general journal to enter our adjusting entries, and the format is exactly like any other journal entry. We'll start the set of adjustments with adjusting entry. So the reader of our journal will know that the journal entries that follow this are all adjusting entries, and we won't have to do an explanation for each entry. So what we need to do is record the $60 used up in supplies. That's why we're going to debit supplies expense for $60. Then we need to bring this $80 down to $20. So I need to subtract $60 from the supplies, and we do that with the credit to supplies for $60. So debit supplies expense, credit supplies. So one way to remember this is the adjusting entries that we're going to be looking at in this chapter will begin with a debit to some sort of expense account. So since we're dealing with supplies here, we're going to debit supplies expense. And we need to adjust an asset account usually. So we're going to credit the supplies. So the expense is always the debit. The account that you're attempting to adjust is the credit. And the amount is always the amount used up. So read the problem, ask yourself, well, how much was used up? And then enter that into the debit and credit. Our next adjusting entry is for prepaid insurance. Remember, we were taught that when we purchased prepaid insurance, we would debit the asset account prepaid insurance because insurance is always paid in advance, and then credit cash. So during June, Mitch paid $700 for a 10-month liability insurance policy. So every month that passes, a 1 month of insurance is getting used up. So what we're going to have to do is expense 1 month's worth of insurance here for the month of June. So step 1 is to find the cost per month for the insurance. So if it costs $700 and it lasts 10 months, that policy is costing us $7 per month. The next step is to figure out how many months have expired. So he purchased this during June, so from June 1st to June 30th is just 1 month. If he had purchased it, say, in May, then May and June would have expired or been used up, so we would have expensed 2 months. But in this case, just 1 month has passed, and that's June. So we are going to expense $70 of this insurance, and we're going to bring the prepaid down by $70. So remember from our supplies example, we always debit an expense. So since we're dealing with insurance here, we're going to debit insurance expense. And then we're going to credit the account that we're trying to adjust, and that was prepaid insurance. The second thing is to use the figure for the amount that was used up, and we determined previously that $70 for the month of June was used up. So we're going to enter that into our debit and credit position. And so that will record $70 in insurance expense, and it's going to decrease prepaid insurance by $70. Our next adjustment is for unpaid wages. So what happens is sometimes at the end of the period, the employees have not been fully paid up. Maybe it's in the middle of a pay period. And if that happens, we need to record how much each person earned each day to record on our financial statements how much we owe in wages. In this example, Mitch's trial balance says that he has already paid his employees $1,650 in wages. And then it says for June the 28th, the 29th, and the 30th, they earned an additional $400 but have not been paid. So the last time they were paid was on June the 27th. So they worked the 28th, the 29th, and the 30th, so they have earned $400 more, but they haven't been paid yet. They'll be paid, immediately when the pay period is over in the next fiscal year or the next period. But for now, for these financial statements, we need to record the $400 that is owed. So we're going to, once again, debit the expense for the account that we're working with, and that's wages. So we're going to debit wages expense for $400, and then credit the account wages payable. Wages payable is a liability that indicates that we owe wages, and so we will credit wages payable for $400. Take a look now at the wages expense account. It went from $1,650 up to $2,050. $1,650 of the wages were paid, $400 is still owed, but we've incurred the full $2,050 in the month of June. So we needed to make sure that these expenses, even though they're going to be paid in the month of July, that they are recorded in the month of June, because that's when they were actually incurred. Our last adjustment will be for depreciation. Now there are several components to the depreciation adjustment, and we will go through those, but first let's talk about what depreciation is. It records the wear and tear on assets. So I can look at a set of books, look at a fixed asset and its related depreciation, and know just how old that asset is. And it'll also tell me, am I going to have to replace this asset in the near future? The second thing that the depreciation adjustment does is it spreads the cost of the asset over the periods used. So remember, equipment may be used for 5 years. And so what depreciation does is it takes a little bit of the cost of the equipment and puts it in each of those 5 years. So it's matching the asset's original cost against the revenues produced over those 5 periods, and it follows the matching principle. Now when we calculate our depreciation, we're going to use the straight line method. There are several methods, and if you take Accounting 1105, you'll learn about 3 more, but for now we're just going to focus on the straight line method. Fixed assets such as equipment are recorded at their actual cost. We call this the historical cost principle. So the cost, or whatever we paid for the asset, stays on the books as long as the business owns it. If for some reason the market value of that asset goes up, it gets more valuable, we're not going to change the actual cost or the historical cost. And we're not going to change it just because it depreciates either. So the actual cost of our asset will always remain on the books at what we paid for it. For example, if we paid $5,000 for that equipment, the cost will remain on the books at $5,000 as long as we own it. To calculate an asset's depreciation, we must determine the asset's useful life. And that's just the period of time that an asset is expected to help produce revenues. We also need to determine the asset's salvage value, and that's just the expected value or selling price of an asset at the end of its useful life. And that's also called the scrap value or the residual value. So for example, if our equipment after 5 years of use can be sold for $200, that would be considered its salvage value. Now we'll take a look at the formula for straight line depreciation. Mitch has motor scooters with estimated useful lives of 5 years or 60 months, no salvage value, and an original cost of $4,800. The formula is to first find the depreciable cost, and that's the original cost minus the salvage value. So we're going to back out the salvage value before we depreciate it. Then we'll take the depreciable cost and divide it by the estimated useful life. Our cost here is $4,800 and no salvage, so the depreciable cost is $4,800. We're going to divide that by 60 months because we want 1 month's worth of depreciation. So $4,800 divided by the 60 months is $80 per month. Now take note, if you were wanting the depreciation for 1 full year, you would divide the $4,800 by 5 years. And that would give you the depreciation for 1 full year. So if you want the depreciation in terms of years, divide by the useful life in years. If you want it in terms of months, use the months for your useful life. Now we need to learn a little bit about a new account that we're going to need for our depreciation adjustment. It's called the accumulated depreciation account, and that's where the depreciation on a fixed asset accumulates. It is a contra asset account, which means it's opposite to the fixed asset. For example, the equipment or the fixed asset is a debit, so any accumulated depreciation that's going against it is opposite to it, so it's going to have a normal credit balance. And the adjustment is to debit the depreciation expense for the amount of the depreciation and then credit for accumulated depreciation. So this is where we're going to accumulate all the depreciation ever taken on an asset. Now let's look at that adjustment. Here we have our debit to depreciation expense. So we are going to debit an expense account like we have been in all of our adjustments. And this is going to go against the revenue to calculate net income. And then here is the accumulated depreciation account. So for this month we'll enter $80, and then the next month we'll enter $80, and the next month we'll enter $80. So you see how the depreciation will accumulate in this account. One term that we need to be familiar with is book value. This is the value of the asset that's going to be carried on the accounting records. To calculate the book value, you will take the original cost of the asset and then subtract its accumulated depreciation. So using Mitchell scooters for an example, his scooters cost $4,800, the accumulated depreciation is $80, so the book value is $4,720. So Mitch's balance sheet is going to show a cost of $4,800, the accumulated depreciation of $80, and then out to the side the book value will be shown at $4,720. Now after we have added all these adjustments, our chart of accounts has expanded a little bit. Under the assets, we've added the accumulated depreciation for the delivery equipment. And notice the numbering. The 185.1 indicates that it is a contra asset, which means it's opposite to the delivery equipment. We've added an additional liability, the wages payable, and we've added 3 new expense accounts: supplies, insurance, and depreciation. Now, anything we put in the journal, remember, has to be posted. So the adjusting entries from the journal need to be posted over to the general ledger. And once we post these, we're going to bring our account balances up to date. So let's go through that posting process. First, we have supplies expense debited for 60. So we'll go to the supplies expense account, debit for 60, and take the balance over as 60. Notice, since this is a special type of entry, under item we're going to list adjusting. For supplies, supplies gets a credit of 60. So we will find the supplies asset account, credit it for 60, and notice once we make that credit, the balance goes down to 20, and that was the actual amount that was supposed to be on hand in the business. And we've also entered adjusting here. For insurance, it's very similar. We've debited insurance expense, and we've credited prepaid insurance, which brings that balance down so that it shows the exact amount of insurance that is prepaid. To help us complete our adjustments and complete our financial statements, we're going to be using the worksheet. And the worksheet is just a tool we use in-house. It's just an aid to help enter adjusting entries and prepare financial statements. There are 5 steps in preparing the worksheet. We'll prepare the trial balance, which we're already familiar with. We'll prepare the adjustments in the adjustment column, which will help us to complete the adjusted trial balance, which is our new trial balance with the correct balances. And then we're going to move the figures on the trial balance over to the income statement and balance sheet, and then we'll complete the bottom section of the worksheet. So here are the first 2 steps. The first column is the trial balance, and that would be completed just as any trial balance would. We would go to the general ledger and enter the balances at the end of the period. The second part is to enter the adjustments. Now notice we have entered the adjustments for the adjusting entries that we just went over. So remember, the first one we debited supplies and debited supplies expense and credited supplies. Then we debited insurance expense and credited prepaid insurance. We debited depreciation expense and credited accumulated depreciation. And then we debited wages expense and credited wages payable. So in the adjustments column, that's what you will find, the adjustments to the 4 accounts that we just learned. In the next step, we're going to complete the adjusted trial balance. And remember, this is a trial balance with the updated figures. So nothing was updated to cash or accounts receivable, but supplies, we had a debit of 80, a credit of 60. We're going to subtract those 2 and come up with a balance on the debit side of 20. With prepaid insurance, we had a debit of 700 and a credit of 70. Since the debit and credit, they're different, we're going to subtract, and we'll get 630 on the debit side. Keep in mind that the delivery equipment is going to stay at its historical cost. It should never change. What changed was the accumulated depreciation. So we did not have a balance in accumulated depreciation. We gave it a credit of 80 and moved that balance over to the credit side. No change in accounts payable. Wages payable had no balance. We gave it a credit of 400 and then took the credit over to the adjusted trial balance. No change in capital, drawing, or delivery fees, but pay attention to wages expense. In this one, we have a debit and a debit adjustment. A debit and a debit, they're alike, so we're going to add those two to get the 2050 debit balance. Rent did not change. Supplies had no balance. We gave it a debit of 60, brought that over on the adjusted trial balance to the debit side. The phone expense did not change. We entered a debit of 70 on the insurance expense and brought that over, and then a debit of 80 to depreciation expense and brought that over. Now, before you go from one column to the next, you need to make sure that your debits equal credits. So, of course, before you do any of your adjustments, you want to make sure your trial balance is in balance. Your adjustments should also be in balance, and you would indicate that at the bottom of the column. And then the adjusted trial balance. Make sure that when you have entered your new balances that you add the debit and credit side up to make sure you haven't made an error. The next step is to move these accounts over to either the income statement or the balance sheet. The accounts that are found on the income statement go over to the income statement column just as they sit. All other accounts go over to the balance sheet. So one little tip is to find your revenue account, and from that revenue down will be on the income statement. All other accounts go over to the balance sheet. Keep in mind that an account will never have a balance on both the income statement and the balance sheet. It's going to be either or. The fifth step and the last step is to complete the worksheet. And what we're going to do is total each column. So this debit is $33.60 and this credit is $8,000. So we need to now get our columns to balance out and calculate our net income. So $8,000 less the $33.60 is $46.40. That's revenues minus expenses. So our net income will be reported here at $46.40. And it does matter which side you put this figure on. You need to put it on the lower of the two sides. You would put it under the $33.60. So you can add the $46.40 and come up with the $8,000. So we'll be leaving these two columns showing as balanced at $8,000. And then you'll go over to the balance sheet and do the same exact thing. You'd add the debit columns, add the credit column, and then subtract the two figures. And you should get the same difference on both sides. If you don't get $46.40 here and here, then there is an error in your calculations. The $46.40 difference for the balance sheet will also go under the lower of the two numbers, so you can add up the numbers and come up with the larger number. So you will end with the balance sheet being in balance at $12,020. When you've completed your worksheet, it's important to remember to enter your adjustments into the general journal. Adjustments sitting on your worksheet will not update your general ledger, so they have to be entered in the journal and then posted over to the general ledger to update the accounts.